Somewhere right now, an investor is trying to withdraw their money. They log in, they submit the request, and the system tells them no, not because they did anything wrong, not because the fund collapsed, but because the fund quietly decided, without warning, without headlines, that it needs to keep their money a little longer, weeks maybe, possibly months. This is not a hypothetical. This is happening right now in 2026. And the institution doing it is not some obscure offshore vehicle. It is one of the largest asset managers on the planet. This is the story of a $3 trillion system built in the dark. And what happens when the lights finally come on? The hidden signal. Most people have never heard the words private credit. That is by design. Private credit is lending that happens outside the traditional banking system. These are not loans from JP Morgan or Bank of America. They are loans made by private funds, asset managers, insurers, and other non-bank lenders operating in what many now call the shadow banking system. Investor place? After the 2008 financial crisis, regulators clamped down on traditional banks. They raised capital requirements. They restricted risky lending. And in doing so, they created a vacuum. Private lenders stepped in to fill it. For a decade, this looked like genius. Businesses that couldn't access bank loans found money. Investors who wanted higher yields than government bonds found returns. Everyone was getting paid. Nobody was asking questions. The majority of private credit loans are sub-investment grade, due to its bespoke nature of lending to companies with lower credit ratings and less ability to access public debt markets. Rebecca. In plain language, these are loans to weaker companies. Companies that traditional banks, the regulated ones, the ones with government backstops, decided were too risky to touch. The private credit industry took those loans and packaged them into products it called stable, low volatility, almost safe. Almost. The pattern. History has a habit of repeating the same trick with different costumes. In 1999, it was internet companies, and the fundamentals didn't matter. The story did. Until one morning, they didn't. In 2006, it was mortgage-backed securities, bundles of risky home loans repackaged and stamped with AAA ratings, sold to pension funds, sold to retirees, sold as safe. We know what happened next. In 2008, the risk was hidden in mortgage-backed securities. In 2026, it is hidden in the double leverage of bank-to-fund lending. Financial content. The costume has changed, the trick has not. Drawing historical parallels with the 1929 Great Depression, the 2008 global financial crisis, and the COVID-19 liquidity shock, analysts identify repeating hallmarks of collapse: extreme asset valuations, unprecedented retail participation, debt saturation, and institutional hedging into gold and Bitcoin. SSRN. Each of those crises had something in common. They were all obvious. In hindsight, the signals were there. The warnings existed, but the system had too much money riding on the illusion to let anyone say it out loud. That illusion is now cracking. The system weakness. Here is what the industry never wanted retail investors to understand. Valuations in private credit can be opaque, and during financial or economic shocks, the diversification benefits evaporate, as the correlation with mainstream credit markets reverts to 1. And the primary concern is then on the return of capital rather than return on capital, trying to avoid defaults at all costs. Rebecca's. Translation. In good times, private credit looks like it moves independently, like it's insulated. But the moment markets get stressed, it moves with everything else. The diversification you paid for disappears at exactly the moment you need it most. There's a second, deeper problem. Many private lenders allowed struggling borrowers to utilize PI key structures, where interest is added to the principal of the loan rather than paid in cash. By early 2026, this phantom income accounted for nearly 10% of the total investment income for major business development companies, effectively papering over insolvency. Financial content peak, payment in kind. A borrower who cannot pay their interest simply adds it to the balance of what they owe. They are not paying their debt. They are growing their debt, and the lender is recording it as income. This is not a niche accounting anomaly. The IMF recently reported that 40% of private credit borrowers had negative free operating cash flow at the start of 2026, a staggering statistic that suggests many companies are only surviving because of the grace of their private lenders. Financial content. 40%, 4 out of every 10 companies in this market cannot generate positive cash flow. They are being kept alive by the very funds that depend on them to perform. When the music stops, who moves first? The escalation phase. Then came the trigger nobody predicted: artificial intelligence. The epicenter of the stress lies in the intersection of high interest rates and the SaaS-pocalypse, a sudden realization that generative AI is eroding the competitive moats of mid-market software companies, which comprise nearly 40% of some private loan portfolios. Financial content software companies were the crown jewel of the private credit universe. Recurring revenues, sticky customers, predictable cash flows. Every major private lender had loaded up. Then generative AI arrived and began doing for free what mid-market software charged subscriptions to do. Customers left, revenues fell, and companies that had been perfectly serviceable borrowers in 2022 found themselves unable to refinance. In early 2026, the Wall Street Journal reported that over $46.9 billion in tech-related private loans had reached distressed levels, signaling that the era of zero-default software lending has officially come to an end. Financial content, $46.9 billion in software loans alone, distressed. And then the dominoes started falling publicly. The crisis reached a boiling point this month when several prominent evergreen funds, most notably those managed by Blackstone, were forced to strictly limit or gate investor redemptions to prevent a fire sale of assets. Financial Content Ari's management opted to curb investor withdrawals from its $10.7 billion private credit fund. After withdrawal requests surged to 11.6%, but Ares capped redemptions at 5%. CNBC Apollo, Blackstone, Ares, Blue Owl, Cliffwater. These are not small names. These are the largest alternative asset managers in the world, and one by one, they are closing the exit doors. Retail and institutional investors who flocked to private credit for its perceived stability and high yields now find their capital trapped in a declining market. Financial Content Capital. Trapped. Why media isn't talking about it. This is the question you should be asking right now. If a $3 trillion market is showing signs of systemic stress, the world's largest asset managers are restricting withdrawals, why is this not the lead story on every financial channel? 3 reasons. First, complexity is the greatest shield in finance. The rapid growth of non-bank financial institutions, particularly private credit markets, has created significant risks for traditional banks and the broader financial system. NBFIs, which often operate with high leverage and rely on wholesale funding, have become increasingly intertwined with banks, leading to potential contagion risks. S&P Global explaining that in a 30-second TV segment requires expertise most newsrooms no longer have. Second, the firms involved are also the firms that buy advertising, sponsor conferences, and employ the analysts who appear as commentators. There is no conspiracy. There is simply an alignment of interests that makes silence more comfortable than alarm. Third, and most critically, FSB staff found sizable information gaps across major jurisdictions, with those regions reporting just $0.5 trillion in private credit activity, far below other commercial estimates of $3 trillion Yahoo Finance. The data doesn't fully exist. Regulators are only now beginning to map the territory. The FSB's inaugural EU-wide stress test targeting non-bank financial institutions is scheduled for 2026 S&P Global, meaning the first serious stress test of this sector is happening as the stress is already materializing. They are building the fire alarm while the building is beginning to smoke. What happens next? There are 2 scenarios. Both are serious. In the first scenario, this remains what analysts are calling a maturing stress. Painful for investors trapped in gated funds, damaging for mid-market companies that cannot refinance, but ultimately contained. A single fund blowing up is not a serious macro headwind. A freezing of wider credit markets is. Capital economics. If the major players can manage the exits quietly and losses remain distributed, the broader economy absorbs the shock. In the second scenario, sentiment breaks. The long-term scenario could lead to a permanent restructuring of the industry. If sentiment does not stabilize by the second half of 2026, the current liquidity squeeze could evolve into a full-blown solvency crisis for mid-market lenders. Financial Content. Here is what a solvency crisis in private credit looks like in the real economy. Thousands of mid-market companies, the businesses that employ between 100 and 1,000 people that make up the backbone of regional economies, lose access to refinancing at the same moment their existing debt becomes unpayable. They begin laying off workers. They default. The funds holding their debt are forced to mark down valuations. Those markdowns trigger more redemption requests. More gates go up. A sharp rise in interest rates on new debt would significantly reduce the value of existing debt, weakening the balance sheets of banks and other financial institutions, undermining confidence, and potentially triggering deposit withdrawals or funding stress. This could lead to a series of cascading failures at financial institutions, which could have ripple effects across the economy, making it difficult for individuals and businesses to make payments or receive loans. Committee for a Responsible Federal Budget. This is not speculation. This is the mechanical description of how credit crises transmit. It is the same mechanism that turned the collapse of subprime mortgages in 2007 into the global financial crisis of 2008. The question is not whether the mechanism exists. The question is whether the trigger has already been pulled. Personal impact. You may be asking, what does this have to do with me? If you have a pension, you're likely exposed. Pension funds across the US and Europe moved aggressively into private credit over the past decade, chasing higher yields as interest rates stayed near zero. The private debt market has increased tenfold since 2011. Many of these credit structures now finance AI projects, cloud infrastructure, or highly valued tech models. If just one of these areas stalls, it hits a system with fewer capital buffers and more outsourcing than a decade ago. Equifin. If you have a job at a mid-sized company, particularly in software, technology services, manufacturing, or any sector that relies on debt financing, your employer may be among the 40% of private credit borrowers with negative free cash flow. Not bankrupt, not yet, but dependent on a lender that is increasingly under pressure to stop being generous. If you keep money in any financial institution that has exposure to this market, and banks have placed a $1.1 trillion bet on private lending through subscription lines, co-investments, and direct funding financial content, the stress does not stay cleanly on the other side of a wall. It seeps. And if you are an investor who reached for yield in the past 5 years and found your way into a private credit vehicle, whether through a wealth manager, a 401k option, or a product that promised bond-like stability with equity-like returns, you may already be in a fund that is calculating right now whether to gate your redemption. The exits are narrowing, and most people don't know they're inside. Cliffhanger ending. There is one more number you need to know. The U.S. is heading toward annual interest costs of more than $1 trillion from 2026 onward. Equifin, the federal government, $1 trillion per year, just in interest. That means Washington has less capacity than at any point in modern history to step in if this goes wrong. The backstop that contained 2008, the emergency facilities that prevented 2020 from becoming a depression, they are more expensive to deploy today, and the political will to deploy them is more fractured than it has ever been. Private credit was built as a system that doesn't need a government backstop, that was sold as a feature. We are about to find out if it is also a fatal flaw. In our next investigation, we will follow the money to a specific set of institutions, the business development companies, that sit at the center of this crisis, that are publicly traded, and whose share prices right now are telling a story that almost nobody is reading correctly. The system is not broken yet, but somewhere inside it, a clock is running. You're watching Future Finance. Stay with us.